So you've brought us some really interesting material to dig into today. Stuff about analyzing financial market data, specifically EURUSD and gold.
That's right.
And I guess the core question at what it really boils down to is, can we actually get a reliable idea of where the market's going just by looking at the color of the trading candles?
Red or green.
Red for down, green for up.
Yeah.
Does a sequence of those colors really tell us anything useful?
That's pretty much the central question, isn't it? And yeah, the sources you shared give us a good angle on it. We've got this analysis done using a Python script that actually looked at real trading data for EURUSD and gold. And there are charts visualizing it, an HTML report, even the Python code itself.
Okay.
So yeah, our mission for this deep dive is basically to see what this data analysis actually tells us about how predictable these simple, color patterns are for these two big markets.
Gotcha. So just for anyone maybe not totally familiar, let's quickly recap the candle thing.
Yeah.
We've got these GARs, right? Represents a time period.
Yep, like a day or...
And if the price ends lower, the bar's usually red.
Yeah.
Ends higher, it's green. Simple enough.
Correct.
But there's this whole idea in trading that patterns of these red and green candles can signal what's coming next. But this analysis we're looking at kind of questions that, doesn't it? It's like, hold on, let's see the proof.
Exactly. I mean, lots of traders do look at these visual patterns, but this analysis, it takes a step back. It's more data-driven.
Okay.
It ignores the theories for a minute and just asks, what does the actual history show? How often does a red candle really get followed by another red one in, say, EURUSD or gold?
Right. Instead of just assuming 3 reds means down, it's actually counting. And it focused on 4 really fundamental patterns, these 2 candle sequences.
Yeah, the real basics. We've got red candle, then a green one.
Potential turnaround, maybe?
Potentially, yeah. That's how some see it. Then red followed by another red.
Downtrend keeps going.
Suggests continuation, yeah. Then the flip side, green followed by red.
Uptrend might be reversing.
Possible reversal, exactly. And finally, green followed by another green.
Uptrend likely continuing.
That's the classic continuation signal for an uptrend, so those 4.
Okay, the basic building blocks. So let's get to the findings. What did the analysis show, starting with gold, XAUUSD?
Well, this was quite striking. For gold, the analysis found that the frequency of these 4 patterns, red, green, red, green, green, it was almost perfectly even.
Even? Really?
Yeah, like remarkably close. The numbers were all hovering right around 25%. I think the range was something like 24.8% to 25.3%.
Wow. Okay. That's basically random, isn't it? Like a 4-sided coin almost.
Pretty much, yeah. It suggests a very balanced market in that specific sense.
So if they all happen roughly the same amount of time, what does that mean for trying to predict gold just based on the last candle?
Well, the implication is pretty clear, I think. It suggests that, at least for the period analyzed, none of those simple 2 candle sequences really gives you much of an edge in gold. Relying just on whether the last candle was red or green to guess the next one, it doesn't look like a very reliable strategy based on this data.
Right. The data just isn't shouting one way or the other.
Yeah.
Okay, now what about EURUSD? The source said there was more variation there. How did it look different?
Yeah, EURUSD was a bit different. One thing that stood out was the red-to-red pattern.
The downtrend continuing.
Exactly. That one actually had the highest share, came in around 28%.
Okay, so noticeably higher than the roughly 25% baseline we saw in gold.
Definitely. And interestingly, compare that to the green-to-green pattern.
The uptrend continuing.
Right. That was actually the lowest, only around 22%.
Huh. So quite a gap there. 28% for red, 22% for green. What does that suggest?
It kind of suggests that, again, for this specific period, downward moves in EURUSD had a slightly better tendency to keep going compared to upward moves. There was a bit more persistence on the way down.
That's fascinating. So a slight edge maybe to betting on another down candle after a down candle compared to betting on an up after an up. What about the reversals? Red to green and green to red in EURUSD.
Yeah, the analysis showed those reversal patterns were generally a bit less frequent than the continuation ones overall.
Okay.
And the source even mentioned something about, I think it was greater instability in upward moves,
right,
which kind of fits, right? If the green to green was less common, maybe those upward trends were a bit shakier, less likely to sustain themselves compared to the downtrends.
Interesting. So gold looks almost random based on color alone. But EURUSD shows these subtle, maybe useful tendencies, like favoring downtrend continuation slightly.
That seems to be what this specific analysis points to, yeah.
Okay, and all this came from that Python script you mentioned.
Yeah.
Can you tell us a bit more about what that tool actually does? How does it get these numbers?
Sure. So this script, it's essentially an automated analysis tool. The source explains it connects to the MetaTrader 5 platform.
Which lots of traders use.
Exactly. It uses that connection to pull historical candlestick data for whatever you tell it to here, EURUSD and gold.
Okay.
Then it systematically goes through that data day by day, and it just counts. It counts occurrences of red then green, red then red, and so on.
So it's crunching through a decent amount of history, not just a few days.
Oh yeah. The code looked like it was set up to grab something like 50 days of data for each run.
Right.
And after counting, it calculates the percentages for each pattern for each day, then averages those out to get the overall distributions we were just talking about.
And it doesn't just give you raw numbers, right? The source mentioned reports and charts.
Correct. It generates a CSV file that's like a spreadsheet file with all the detailed daily stats, useful if you want to dig deeper yourself. But it also creates a graphical HTML report that probably includes bar charts showing those average percentages for gold and EURUSD side by side. Makes it much easier to see the patterns, or lack thereof, at a glance.
Yeah, visualization helps a lot. Now, for someone listening who thinks, okay, this sounds cool, but Python, MetaTrader, the source did mention some technical bits. What's involved there?
Right, it touches on that. It's Python code, so you need Python. And it relies on a few specific libraries, like add-ons. There's one called MetaTrader 5 for the platform connection.
Makes sense.
One called Pandas, which is super common in data science for handling data.
Like a powerful spreadsheet in code.
Kinda, yeah. And Pititsits for handling time zones correctly, which is important with market data. And crucially, you do need the actual MetaTrader 5 trading platform installed and running on your computer. The script needs that to get the live or historical data.
Okay, so definitely a bit of setup if you're not already in that world. But didn't the source suggest some ways around that, or tools for beginners?
It did, yeah. For folks maybe less comfortable with setting up coding environments, it suggested things like Replit or Google Colab.
Those are online platforms, right?
Exactly. You can often run Python code right in your web browser, sometimes without installing much locally. It also mentioned Cursor IDE with GitHub Copilot. Those are more advanced tools, but they use AI to help you write and understand code.
Okay, so there are options depending on your technical level. Good to know.
Yeah, definitely pathways to explore this kind of thing, even if you're not a coding expert.
So let's pull it all together then. Looking at this whole analysis, the data, the script, the findings for gold and EURUSD, what's the main conclusion? What's the big picture message here?
I think the primary takeaway is really one of caution. The statistics suggest that for these markets during this period, the market is generally balanced. That's the term used. Meaning predicting the next move based only on the color of the immediately preceding candle doesn't seem to be strongly favored one way or the other. It's not a magic bullet.
Right. No easy answers just from red or green.
Yeah. Exactly. So the source advises caution about making trading decisions just on that simple signal. But importantly, it also frames this kind of tool, this data analysis approach, as a potentially really valuable starting point.
How so?
Well, instead of just assuming patterns work, you can actually look at the data for the specific market and time frame you care about. It helps build strategies that are maybe more grounded in reality, more precise. It encourages looking at the numbers.
Okay, so for everyone listening, the key insight seems to be that temptation to just guess the market's next move based on the last candle's color. The data here suggests that's probably not a very reliable strategy on its own, especially for gold. For EURUSD, maybe a tiny hint towards downtrends continuing, but overall it's far from a sure bet based on this analysis period.
Precisely. And, stepping back, it makes you wonder, doesn't it? This whole idea of testing assumptions with data. How does that apply elsewhere? Like, how often do we rely on simple rules of thumb or gut feelings in other parts of life? Does looking at the actual data, the real-world evidence, often challenge those intuitive leaps we make?
That's a great point. We see a simple pattern and assume it means something definite. This deep dive really shows the value of, well, digging deeper, right? Going beyond the surface visual and looking at the actual numbers underneath.
It absolutely does. It highlights that need to question and verify.
Which leads to maybe a final thought for everyone to mull over. If these simple visual cues, like candle colors, aren't always the reliable predictors we might wish they were, what else is going on? What other layers of information, what other factors are really crucial for making smart decisions when you're dealing with complex systems?
Yeah, whether that's financial markets or, anything complex, what are those deeper signals we should be looking for?